Today we're going to see about the final accounts. Final accounts are the accounts which are prepared at the end of the year. It gives a idea of financial position of business organization to the owners, management and other instructed parties. Financial statements are primarily recorded in the journal and transferred to the ledger, and the last process is the final accounts. There is have a few components. First one is trading account, manufacturing account, profit and loss account. Then last process is the balance sheet. First we going to see about the trading account. Trading account represent the gross profit, gross loss of the concern out of sale and purchase of the particular accounting period. First one is opening stock, unsold closing stock of the last financial year is appropriated in debit side of the trading account as opening stock of the current financial year. Next one is purchase. Total purchase including cash purchase and credit purchase of traded goods during the current year financial year appropriated to purchase in the debit side of the trading account. Next one is direct expenses. Expenses insured to bring trading goods at business premises, warehouses called direct expenses. Freight charges, cartage or carriage charges, custom and import duties in case of import, gas, electricity, fuel, water, packing materials, wages and other expenses are called the direct expenses. Next one is sales account. Total sale of the trading goods including cash and credit sale will appropriated to outer column of the credit side of trading account by sales. Sales should be Next one is closing stock. Total value of unsold stock of the current financial year is called as closing stock and will appropriate at the credit side of the trading account. The formula is closing stock equal to opening stock plus net purchase minus net sale. Next one is gross profit. Gross profit is the difference of revenue and the cost of providing service or making products. However, it is calculated before the determined payroll. The formula of gross profit is equal to sale minus cost of goods sold. Next one is opening profit. Opening profit is the difference of revenue and the cost generated by original operations. However, the calculation before the determining tax, interest payment, investment gains, loss, etc. The formula is operating profit equal to gross profit minus total operating expenses. Next one is net profit. Net profit is the difference of total revenue and the total expenses of the company. It is also known as net income or net earn. The formula is net profit equal to operating profit minus taxes plus interest. This is the format of trading account. See, there is have a two sides, debit and credit side. From the debit side, first one is opening stock, then purchase. You want to list the value of purchase written from the purchase. Next one is wages, carriage inwards, freight inwards. Then the credit side, by sales, list the value of sales written from the sales. Next, closing stock. Then the balance figure is mentioned from the debit side is called the gross profit. Then the balance figure of the credit side is called the gross loss. Next one is manufacturing account. Manufacturing account prepared in the case whether goods are manufactured by the firm itself. Manufacturing accounts represent production, cost of production then transferred to trading account whether the traded goods also traded in the same manner of trading account. First point is raw material. Raw material is used to produce product and there may be opening stock, purchases and closing stock of raw material. Raw material is the main and basic material of produce items. Next point is work in process. Work in process means the product which is still finished but they are import part of the opening and closing stock. To know the correct value of the cost of production, it is necessary to calculate the correct cost of it. Next one is finished goods. Finished product is the final product which is manufactured by the concerned business and transferred to the trading account for sale. This is the format of manufacturing account. There is also have two sides. First one is the debit and credit side. Debit side, direct material, opening stock, raw material, work in process, then purchase, raw material, work in process, carriage inwards. Then the direct labor is called the factory wages. Then direct expenses, factory rent, fuel, power, gas, etc., factory insurance, depreciation. These are all called the direct expenses. Come to the credit side, closing stock, raw material, work in process, cost of the goods. Next we are going to see about the profit and loss account. Profit and loss account represent the gross profit as transferred from trading account on the credit side for it along with any other income received by the firm like interest, commission, etc. Debit side of the profit and loss account is summarized of all the indirect expenses as incurred by the firm during the particular accounting year. For the example, administrative expenses, personal expenses, financial expenses, selling and distribution expenses, depreciation, bad debts, interest, discount, etc. This is the format of profit and loss account. First one is salaries, rent, rate, insurance, depreciation, interest on capital, bad debts. These are all come from the debit side. Then the credit side, interest received, commission received, bad debts received. These are all comes to the credit side. This is the format of profit and loss account. Then the last one is balance sheet. A balance sheet reflect the financial position of the business for the specific period of time. The balance sheet is prepared by the asset, fixed asset plus current asset, and the liability, long-term liability plus current liability. Fixed asset. What is mean by the fixed asset? Are the purchased construct asset used to earn profit not only in current year but also in next coming year. However, it also depend upon the life and utility of the asset. Plant and machinery, land and buildings, furniture and fixtures. These are all the fixed asset. Next one is current asset. Current asset which are early available in discharge current liability of the firm called are current asset. Cash at bank, stock and sundry debtors are the example of the current asset. Next, there is have a few extra points. The important is tangible asset and intangible assets. What is the tangible and intangible? The asset which can be touched, seen, that is called the tangible asset. The asset which are variable in the nature but cannot be seen, touched, that is called the intangible asset. Then the last one is current liability and the long term liability. The liability which are extracted to the liquidity by the end of the current year are called the current liability. For the example, taxes, accounting payable, wages, these are all. Next one is long term liability. The liabilities which are extracted to be liquidated in more than the year are called as long term liabilities. For example, long term loan, bonus, etc. This is the format of balance sheet. Thank you, students.